It's August 18th, and this is the video that takes 30,000 to a million. I'm actually super excited about this one because I've done some work, and hopefully I deliver some shocking numbers by the end of this. So, but first, before I get to what I've been doing, which is a very quick relative company valuation, and I've done it for JD and Alibaba compared to both Amazon and Apple, which are two of the strongest companies in the world, and biggest. So let me go into the account. Oh, by the way, I'm also excited that I've been tinkering a little bit more with the video. So hopefully the video quality is even better than ever. So we'll see if I can keep improving it, just for this video log here. So let me get into the browser and I'll show you where my account is sitting at right now. I'm at $157 $1,000, and today was kind of rough. Negative 1.28%. My positions are on the right here. You can see the options first. I'm going to scroll through them really quickly. You can see the ticker, the strike price, whether it's a put or a call, expiration date, number of contracts, and whether it's a seller or a buy. You can see the number on the right represents the daily valuation change, and the percent in percentage terms and in dollar terms, which is kind of neat. And after I go through this, you can pause the video at any time to kind of find out all of the relative information that you might need. I'm going into my equity part of the account. Minus $2,000 on Apple, which kind of hurt today. I think it's because of the raising rates possibilities and tapering kind of program that has been rumored about. I didn't actually watch the minutes or anything like that from the Federal Reserve, so I'm not sure exactly how it went. But either way, 2.6% almost down today. eBooks also down as usual. And then we have Alibaba and JD. JD actually scored a green day, which is amazing, considering what's going on. So I think I reduced another position. Let me see. 1, 2, 3, 4, 5, 6, 7, 8. No, I still have 9. And I can count. So that's great. Everything else was red a little bit, but the other positions are somewhat insignificant at this point. Past realty income out here. Ticker symbol O. So this is the account tab, just to show you real quick. I'm controlling 210,000 roughly dollars, of which 53.5 roughly are margin. I am now over 25% margin, 25.45. So that's where I'm sitting at right now. Here is my weekly performance. It's pretty sad. Down 7% or $12,000. Month sitting almost flat there. Actually, what is it? Minus 3%. 3 months I'm somehow still positive. I don't know how. And my year is of course positive, but not by that much anymore. Okay, so next, a quick market overview. I'm not going to spend any time here, but just basically it's kind of a thanks ad. It's kind of a red day, but some notables that are positive are Tesla, and then of course JD.com, and then PDD, and you can see Dash up there, Airbnb. There's some green, but for the most part the entire market went red. Some notable reds are of course Apple and other tech related names like AMD, for example, etc. Let me see how much you can see from this map. Yeah, you can see enough. Everything that matters. The two red names in the bottom right that you can see are just basic materials. They're like, whatever, the big mining. What are they? BHP, Billiton. I forget what their names are right now. But Rio Tinto is also down, etc., etc. Yeah. All right, moving on. So here's what I've done. 1 second here. Let me explain you what I've done here. So I've created this little formula after thinking about it for a long time, and I use it to try to kind of get a better sense of a relative valuation when it comes to a specific type of stocks. You can't really do it on every stock, and even this type of valuation is not very accurate. It takes a lot of things out of the equation. Okay, things like assets, things like that. So it doesn't. It just purely deals on a few factors, but it helps to get an idea of how undervalued or overvalued something could possibly be relative to another company's metrics. Now, as I'm looking through some of the FinViz data, you can see, I'm going to point out some differences about the companies that are positive and negative, so you can see kind of that how imperfect this formula is. So I don't want you to take everything for as truth there. Okay, so I'm just going to quickly go through the, let me see if I can make them more visible here. Okay, that's good. Okay, perfect. All right, excellent. So some things I want to point out is that some of the companies have a pretty good metrics in some regard. Like for example, the price per sales are pretty good for Alibaba. Like mainly, I want to look at things like debt and cash per share. So Alibaba and JD are very much cashed up compared to their Western counterparts. And Amazon and Apple, we're gonna take a look at it first. Only 3.74 billion per share, and then we have only 176, not billion. These are not billions. These are just dollars per share. And then we have $177 per share for Amazon, which is not that much. So you can see how the Chinese counterparts are more cashed up, and also you can see the debt to equity ratios. You can see it's 0.59 here, and 0.58 for I think long term, and then Apple is 1.89. So their debt burden is kind of increasing, because of, I don't know, whatever they're spending their money on, and the long term debt's 1.65. So the ratio is not as healthy as, let's say, the Chinese companies. But there are other metrics that are simply phenomenal and can't be ignored. Like for example, the return on equity. Now I know these numbers that they get changed based on what's been happening with the company lately, like what they're doing internally, how they're slushing the numbers in and out, and what they choose to report or not. So you can't just take these numbers at face value and just say, okay, this is what's going on with the company. The way that the reporting works is different now. Some rules where you take into account in the profitability, like stock gains and market operations and things like that. So it just matters what bucket things are put into and what bucket they're not put into. So you have to really dig in very deep if you want to be accurate and thorough about this. But this is just kind of like an overview to give you an idea rather than taking this as gospel. However, even knowing that, you can see there's a lot of green here on the margin side and the return side of the equation. And although JD also has very nice return on equity, 31%, everything else looks pretty average. They do a lot of reinvesting with their capital, so that's to be expected. But profit margins currently sitting at 6.5, which will come into effect later. But some other things that are nice are return on assets is 13%, whereas Apple's return on assets is 25, and Amazon is only 9.2, relatively speaking. I only say only, and so is Alibaba's 9.1. Okay, you can see Alibaba return on equity 16, return on investment 1.4. I like these numbers to be large for any company that, jumped ahead for a second, my bad. I like these numbers to be large for any company that I'm looking at. I don't want to buy anything with negative numbers, even though it might be in a hyper growth stage. So anyway, some other things that I want to point out here is, that's pretty much it actually. So now I can go into the relative valuation metric that I'm choosing here. So I developed this formula, and it will make sense. It might make sense to you if you kind of work through it and figure out why I've done what I've done. But basically what I've done is I've taken the revenue of the company that I'm comparing the new company to. So let's say the what is it called? The not barometer, the benchmark. The benchmark company would be number one. So I take the revenue of benchmark company one, and divide it by the revenue of the second company that I'm trying to look at. Then I multiply it by the market capitalization of that second company. Okay, so because I'm looking for a ratio, I want to multiply it towards that towards the size of the company. And then I take profit margins into account, because what good is all that money if you're not making any, if you're not licking any off the top. Yes, I know you might be reinvesting, whatever, but let's just say for investment purposes, as an outside investor looking into the company, like how much of that money are you actually profiting and perhaps returning for buyback shares, or dividends or whatever, or just as reserves. So I take the profit margin of the first company divided by the second company, and then take that number, and I have the original value divided by that, and that is going to give me the relative market capitalization of the relative market cap value of what the company I'm looking at should be. Okay, and in one case it was pretty astronomical. You'll see which case I'm talking about. And so if I want to convert that into share price, that's a very easy thing to do. So we take that relative market cap valuation divided by the market cap of the second company that I'm looking at, and I just multiply that by the share price, and there I get the relative share price target, right? So what I'm looking at from this relative valuation metric, what target price I'm looking at for the company to be worth, right? If it was valued like the benchmark company. So let's say Amazon and Apple are benchmark companies. Obviously, pretty much every company is going to fall short of that benchmark just because they're such spectacular, phenomenal companies, right? So we're not going to expect, we might expect companies like that to be overvalued relative to them, but for the most part, if they're in the same kind of group, dealing with consumers and retails and stuff like that, then they're probably going to be, worse off. But we'll see. So let's go back into the browser, and I'll show you some of the spectacular conclusions that I've come up with. So I've taken the revenues. So let me walk through an example first. So I think the first one I did was JD versus Amazon. So I would take the revenue from Amazon, just to walk you through an example here, which is 443 billion. And then I would go to, let's see what, I gave you a sneak preview, oops. Let's go. And then I divided by the revenue of JD.com. All right, which would be 123.92. Just obviously these numbers may not be like exactly correct, but that's not the point. You just want to get kind of a quick look. And then what you want to do is take the profit margin of one divided by the other. So profit margin Amazon is almost the same as JD. So it's 6.6, JD is 6.5 over here. So once I've taken that, then I can now divide those two numbers, and I get the relative market capitalization, okay, of JD. So I've already done that. I'm not going to tell you the number, but I'm just going to show you the final result. Okay, so the final result is I've taken that market cap target, and I've derived the share price from it, and the result is actually quite fantastic. Okay, so for the first one it's not, but look at this. So JD versus Amazon. If JD were to be valued like Amazon is on the US markets, it would be at $193.34. And if I then compared Alibaba and Amazon, and if Alibaba was valued like Amazon using these metrics, then it would be worth $1,892.33. And currently it's like $172 or something like that. So it's a pretty drastic deviation from the current price. So it's definitely not valued like Amazon, right? And then JD versus Apple actually is a very interesting result. So Apple is such a high quality company that using this metric versus JD, J would actually have to drop down in price to $47.68 if it was valued like Apple. So you could actually argue that, knowing that JD is pretty undervalued, you could actually argue that Apple is undervalued. Um, so of course I did the same thing versus Alibaba and Apple, and Alibaba came out with a target price of $387.57, which is, like more than 2 times the price that it is right now. So I mean, I think the Alibaba versus Apple comparison is pretty good, and then JD versus Amazon is pretty realistic as well. Um, but it just kind of gives you a little bit of, I guess, one interpretation that at how undervalued or overvalued a company might be relative to another. And the reason I embarked on all this, honestly, is I wanted to find out what the political risk premium is on these Chinese stocks. So it looks like that it might be like 2 or 3x, just about, the political risk, or even more, of the actual value of the company, what he would be valued if these companies were in the US with the same circumstances. Let's say if China was a territory of the US or something, or a state. Then this is what these companies could be worth. So I thought that was really interesting. I'm glad I did this exercise because it gave me some clarity and some targets and some new ways to kind of think about it. So I've been thinking about this formula while I was at work today, and just it just made so much sense to me. So let me know what you think about it. Let me know if you have some formulas of your own that you use. I'm always looking to learn. So if you have something interesting that you want to share, let me know, because I could always use a different point of view, a different perspective, what I'm trying to do to try to, evaluate my actions out here. But I think I'm gonna end it right here because this video is already pretty long. So hopefully the video is better. I think it looks better. And I think that's it. All right, peace out.